If one were to mention PEG, especially for those of you from the 1900s, you might have thought of Married with Children's Peg Bundy. Or maybe for those of a little bit younger, you might have thought of Peg Griffin. But in the stock market, PEG means something entirely different. In the stock market, the PEG, or the PEG ratio, is the PE ratio divided by the growth rate of a particular stock. The PE ratio comes from the valuation of a security, wherein it's the next period dividend, coming from next period earnings, times the payout ratio. Here we're using conventional notation, where the payout ratio is 1 minus the firm's retention rate, typically called B. So 1 minus B is the payout ratio. Then it's divided by the difference between the firm's discount rate, accounting for risk, and its growth rate. Now, for most securities, the firm's growth rate is determined by the firm's retention rate, what they did not pay out, times the firm's profitability, or G equals BR. And further, in equilibrium, or on the margin, the PE ratio has been repeatedly shown to be the reciprocal of the going yield, and you can see the math here where when K equals R, the 1 minus B cancels out and it becomes the reciprocal. And in fact, let's look at some historic graphs here, a nice detailed one and a more simplified one showing the profound inverse relationship between yields and PE ratios. Now let's look at the PEG ratio itself. It's the PE ratio, again, divided by the growth rate. Computationally, it's done as a percentage with the idea of looking for something as a benchmark where the PE ratio would equal the growth rate, or a 1-to-1 ratio, mindful again as a percentage. It was created by Mario Farina in '69 and 20 years later promoted by Peter Lynch. If you work out the mathematics, however, you come to an anomaly. Notice on the bottom line, just substituting through, you get units that don't make any sense. You have a growth rate squared, and moreover, it seems to be a double counting of the growth rate. To put it another way, the PEG ratio is trying to capture how much of the growth rate is attributable to the PE multiplier. It still begs the question, though, that the units are just bizarre. And God forbid if you tried to figure out an equilibrium solution, remember that's where G equals BR, or BK, the retention rate times the discount rate, and you wind up with something like the discount rate squared times the retention rate as a reciprocal. It doesn't make any sense. Offered for your consideration is something I've looked at before. The yield times the PE, giving you a payout ratio. And the payout ratio certainly is not trying to measure the same thing as the PEG ratio. With the payout ratio, it's kind of a bird-in-the-hand philosophy, with the bimodal extremes on both sides. On the low side, the firm's doing poorly, can't afford to pay out. On the high side, it's risky again, but for a different reason. It's risky, new startups, possible growth rates may fail. Well, that's been a look at the PEG ratio, which is the PE ratio divided by the growth rate, which at least mathematically makes no sense, and a payout ratio using a Dr. C shortcut. Just multiply the yield times the PE, keeping you up to date.